Hey, everybody. Welcome back to the Blockware Intelligence Podcast. Hope you're all doing well. Before we get into the show, let me tell you a little bit about our sponsor, FTX US. FTX US, one of the largest crypto companies in the United States, is the safest, most regulated way to buy and sell Bitcoin, Ethereum, and other digital assets. You might have heard of FTX from their partnerships with Tom Brady, Steph Curry, or the recent Super Bowl commercial with Larry David. With FTX, you can trade crypto with up to 85% lower fees than top competitors. There are no fixed minimum fees, no ACH transaction fees, and no withdrawal fees. You can also use the FTX app to buy your favorite NFTs with no gas fees, supporting both Ethereum and Solana blockchains. Download the FTX app today in minutes by going to ftx.blockwareintelligence.com to earn free crypto on every trade over $10. Again, that's ftx.blockwareintelligence.com to get started today. Hey, everybody. Welcome back to the Blockware Intelligence Podcast. Hope you guys are all doing well. Today, we've got two very special guests on the show for you. Two people I've really been looking forward to get to sit down and speak with. And of all days to talk, today's a pretty interesting day. So I want to thank and welcome Matt and Josh from Genesis for coming on the show. I guess we can first start with Matt, if you want to kind of just give a high level of your background, how you got into crypto and what do you do at Genesis?
Yeah, absolutely. Thanks so much for having us on, Will. It's been it's going to be great. I mean, we've been looking forward to it for a long time as well. So my background, I'm Matt. I run Genesis's. I'm co-head of our lending and trading business. Have been with the firm for about 5 years, and really started back in 2017 in the early days. So I think I was the 9th employee. We're about 225 people now. So I've obviously seen a ton of growth, not only in the market, but also, at Genesis. We've really kind of grown our business, in an order of magnitude since I first joined. So my responsibility really has been focused on kind of growing our lending business over the last few years. We're now one of the largest institutional lenders in the market. So we're facing off against, some of the most well-known crypto native hedge funds, traditional hedge funds, a lot of the prop trading firms out in Chicago that people know of, like Jane Street and Jump and DRW. We're facing a bunch of the kind of other dealers in crypto that need to kind of work their balance sheet. And our loan portfolio today is about 15 billion. So it's a pretty substantial business for us. And then more recently, I've kind of shifted gears a little bit to kind of just focus more holistically on how Genesis, can deploy its balance sheet in the optimal way. So looking at kind of new strategic opportunities for us as a business. So prior to Genesis, I was at Bridgewater Associates, which is obviously a pretty iconic global macro hedge fund run by Ray Dalio. I was there for about 3.5 years, mostly focused on like the portfolio construction and kind of market research side. But that's really where I got into trading on here. It's funny because one of the guys that worked with me at Bridgewater actually wound up leaving a year before I did to go help spearhead Grayscale Asset Management, which is one of the largest asset managers in crypto and the sponsor of the Bitcoin Investment Trust. So he and I started talking for about a year, and then I ultimately took the leap of faith and wanted to kind of come create traditional capital markets in an emerging asset class that really didn't have anything. So that's how I got here. Prior to that, I got some kind of just traditional capital markets reps at Fidelity, which is where I started my career at Boston.
Hey, Will, this is Josh. Very happy to be here with you on this podcast. I work with Matt at Genesis. I work on the derivatives trading desk here, and our business is focused on sort of importing a lot of the instruments and types of trading formats of touching crypto in a lot of different ways that you could find in traditional markets. So, things like options, things like forwards that you'd want to, use to hedge your book or express a certain view. We're trying to offer those products to institutional investors that are getting into crypto for the first time. The business itself is pretty new. It's about 2 years old. That's when I joined the company. Prior to Genesis, I kind of had a little bit of a winding road through different firms in TradFi crypto. I started my career at Goldman in equity derivatives, and it's kind of funny. Like when I started, it was sort of we were just coming out of the financial crisis, so this 2009. And, obviously it was a pretty strong year for just a couple of years actually for the banking sector as everything rebounded. But there was always sort of, this sort of lingering mistrust of the sector, at least among the mainstream kind of population. And I think that was kind of, for a lot of people, the impetus to like look at other things that were going on in fintech at the time. A lot of my colleagues were leaving. I had actually a good friend at Goldman that started this exchange called LedgerX, which I think we all know now as having recently been bought by FTX. But that's kind of how I got into crypto. He introduced me to the founder of a company called Circle, which back then was more a consumer trading sort of and payments app. And I was sort of running the treasury business for Circle and connecting the pipes to exchanges and to large sources of Bitcoin at the time for our retail customers to buy. And that was a big change for me. I had previously really only traded equities and really only traded derivatives, but that's how I kind of got into the trading aspects of crypto and the institutional aspects as well, sort of dealing with large counterparties, large asset managers, corporates, miners, kind of everyone in the early days. And this is kind of even before ETH was really a thing back then. So I did that for a while. And kind of every subsequent step I've had in crypto has sort of been more getting back into an institutional trading seat. So, as the markets shifted from 90% retail to 10%, and 10% institutional to the other way around, it's maybe like, more 60, 70% institutional nowadays. The nature of, the trading seats have also changed for me over time. I worked at Galaxy for a little bit, helping them to build out their spot and derivatives business kind of in the early days. And then 2 years ago, like I said, I came here. And since then, the market sort of exploded for derivatives in general, but also sorts of more sophisticated instruments for people who want to access the asset class. So that's really what we're focused on here, is sort of building a very, white glove sort of service for institutional investors that need that, sort of help to get into the space.
No, that's super interesting, and I definitely want to kind of dive into the quote unquote institutionalization of the market in a moment. But first, I want to start with, just to kind of paint the picture for listeners, can we just talk through the different branches of the overall Genesis business? You got a lot of stuff going on, right? You've got lending, OTC desk, derivatives. Kind of, if you could walk us through each different, from a high level, branch of the business, and how do they kind of tie in together?
Yeah, definitely. I can start, and then I'll let kind of Josh can dive into his business a little bit. But so for those that don't know, kind of just stepping back, Genesis has been in the market really since 2013. So our parent company is called Digital Currency Group. They're one of the largest investing companies in the space, and they're led by a guy named Barry Silbert, who's obviously a pretty well-known kind of early evangelist in Bitcoin, and one of the kind of first early adopters. And, Genesis kind of got its start really actually trading non-crypto. We were trading like Facebook private stock, auction rate securities, and other kind of illiquid instruments, until Barry ultimately said, I want to go all into crypto and start trading Bitcoin. This was, I think, in 2013, 2014. So he wound up selling the other business to NASDAQ Private Markets and starting Digital Currency Group. And Genesis really spawned from that as kind of the first really like institutional, licensed, SEC regulated broker dealer that made markets in size in Bitcoin. So that's kind of how we got our start. And then obviously we've evolved a ton since then. So the different components now, right? We have our spot trading business, which literally trades probably, I don't know, Josh, maybe 50 or so different crypto assets now. Obviously, a lot of that flow is going to be in Bitcoin, ETH, and some of the other kind of major L1s. But for a long time, it was really just predominantly Bitcoin. And, that business is probably doing anywhere from 15 to 20 billion or so in kind of notional volume per quarter. And then the next business that spawned after that is our lending and financing desk. So you could think of this very similarly to like sec lending or, repo trading at like a bank or a prime broker. And, we're basically providing balance sheet to hedge funds, other trading counterparties, principal traders, dealers, high net worths that basically need capital to either go long through our desk on leverage. So like kind of like margin trading, or go short through our desk on margin, or just that need working capital to trade across a variety of different venues externally where we can manage that risk. So, that business we started in March of 2018, and it's ballooned a ton since then. It took us maybe a year to reach 100 million in loans outstanding, and then another year to reach $1 billion, and then like 4 months to reach a loan. And it was pretty incredible to watch. And, we're facing maybe, there's probably about 200 or so kind of unique institutions that borrow from us. And, we've done over, honestly, probably 100 billion in kind of loan origination since we incepted. So that's the second part of the business. Then there's derivatives, which Josh will touch on in a second, which we launched about 2 years ago. And then lastly, there's kind of custody, which is like really the bedrock of any prime broker, which is what Genesis is really trying to be. And that's just kind of the safeguarding of assets, which has kind of almost become like table stakes to the market at this point, right? Like if you're going to have people trade through you as a one-stop shop venue, you need to have a place to kind of hold those keys and hold the assets and then allow them to do different things with those assets, whether it's trading, borrowing, or lending. And so we kind of package all of that up and say, here are all the different business lines and things you can do. And we want to basically give you a single point of access to do that in the most capital efficient and kind of opportunistic way, facing a really well-regulated licensed entity in Genesis. So that's kind of like our business holistically. And then, I didn't touch too much on derivatives, so I'll let kind of Josh dive into that a little bit as well.
Yeah. Before we toss it over to Josh, I do have like 2 questions on the lending branch of the business. The first one is like, I was going through this report, kind of what you were just talking about, the explosive growth in this chart of the lending. Can you kind of describe for us, you kind of talked about like who would be, borrowing and lending and some of those entities and like what their incentives are around doing that. But have you been surprised over the last quarter to see such an explosive growth in lending, despite kind of, the market slowing down?
Yeah, it's a good question. And I think like so let me break down kind of the use cases of like why people borrow and like what they're doing. And then why I think we've still seen some significant growth despite like a pullback really in everything, in price, in spreads, in interest rates, or at least in crypto rates. So I think, there's really like 3 reasons why people borrow from Genesis. One is to really just trade on margin through our platform, right? So they're borrowing dollars to lever up, right? They might want to put on $100 million Bitcoin, and maybe they'll park half of that as kind of margin with us, and they're borrowing $50 million to get long exposure, and then we're managing that kind of as a margin trade. Similarly, but inversely, they can also want to go short, and maybe they're going short, ETH versus Bitcoin, and so they actually get a borrow from us in ETH. We lend them the ETH, they sell it back to us for Bitcoin, and we hold the Bitcoin as collateral to back that ETH loan, which acts similarly as a margin loan. So that's kind of use case number 1. It's a pretty big part of what we do. Obviously, you can look at other exchanges like FTX and Binance, and there's a ton of margin trading, happening on those exchanges as well. Ours just happens to be done in kind of as institutional or OTC format. The other use case is like financing, big market makers. So like Susquehanna, Jump, Jane Street, DRW, that obviously like need to go make tight spreads on a variety of different exchanges, and they need working capital and balance sheet to go do that. So what do? Like, they're not going to go long delta and then like use that delta to support their positions on exchange. They're going to borrow capital from basically like a wholesale lender like a Genesis to go do that. So that's kind of like the second bucket, is really like this market neutral support that we provide to large trading firms to go, kind of basically trade on various exchanges. And that might mean supporting their client flow. It also might mean trading, principally in capturing spread across derivative and spot markets. And then lastly is like non-trading related financing. Maybe it's like equipment financing for miners where they need capital to go purchase new machines to upgrade their facility. It might mean like shorter term float for different exchanges. So this is basically like non-trading related, and it's a smaller part of what we do. So those are like the 3 buckets. And then I think a lot of the growth has just come from the second bucket, which is really the emergence of like a ton of different institutional kind of trading venues that need balance sheet. And the larger the ecosystem gets, the more of these firms that are just kind of coming into the space and entering that want to kind of trade on a delta neutral basis. And there's not that many lenders that have balance sheet like Genesis. And so, we're obviously kind of naturally going to be the primary lender to the emergence of many of these different platforms. So even though like there's less leverage in the system and like there's less people using dollars to go long Bitcoin, you can kind of see that expressed in spreads and basis, which we can get into later, there's still just like usage of capital that's increasing really as the adoption curve like continues to go one way, right? Like as this market continues to mature and institutionalize, there's just going to be more folks that need capital to trade on venues. And we're going to be, the ones basically underwriting that risk, providing the capital, and kind of growing with the market. And that's really where a lot of the growth has come over the last like year or so.
No, that's really interesting. And the other thing I wanted to ask you before tossing it over to Josh is like, how do the dynamics around lending in crypto differ from, I mean, obviously you both have, widespread traditional finance background. So how does lending in crypto, given the, kind of 24/7 nature and like extreme volatility, differ from lending in traditional finance?
Yeah, it's a good question. There's a lot of similarities, but then there's also a lot of differences. So like the similarities I would say are the style of lending, right? And the structure works pretty similarly in that like, when we lend dollars for crypto collateral here, it's very similar to a bank lending, dollars backed by Apple stock or Tesla stock to a fund that wants to basically lever up his portfolio holdings. And then if we lend coin, for the purpose of shorting, it's very similar to a company kind of getting a locate, right? Or a hedge fund getting a locate to go short through their PB. So like the structure and style of what we're doing is like pretty similar to traditional finance. Obviously, like there's a lot of components that are different. So number one, I think is just like that's the overall size of the market, right? Is a lot smaller in crypto. There's just a lot less, a lot less capital to kind of go around. And there's still a lot of demand for leverage. And so you get like a lot of, really like mispricing and arb opportunity in our space, right? That's why you kind of see interest rates where they are, right? To borrow dollars in crypto, it's cost you anywhere from like, 5 to 15% over the last, 2 years. I think annualized basis traded somewhere in like the low 20s in probably 2020. So like it's been super cash starved market because of just how much less balance sheet there is to kind of go around for a community of funds and traders that like have a lot of appetite to go long. So there's just like a mismatch in really the supply and demand of dollars in our market that's starting to come in, but that's been one huge difference. And then more like operationally and practically, there's differences such as just the 24-hour nature of crypto, right? Like we have to manage margin through the weekend, through the night. And so you really have to be global and have an operations risk, market risk, credit risk team set up to do that well. You can't really do that if you're just working New York hours and you have counterparties in Asia. So really, managing that obviously is a lot different. And I think it's made the market just a lot more competitive to have to do that. And then lastly, like you get other nuanced things such as like having to think about staking, right? And how does that like impact the returns on a loan? Where like, am I entitled to the staking returns? Are you entitled to the staking returns? And things like hard forks and airdrops and how like the ownership rights change over that, depending on, is it the lender that gets it? Is it the borrower that retains the rights to those things? And then how do you craft that into legal agreements to kind of execute that well? So there's a lot of kind of differences there that just have to be kind of thought through and understood. And then you just have to be, spread out globally and be willing to kind of operate 24/7 to do it well.
No, that's fascinating. And Josh, I now want to kind of turn it over to you for the derivative side and kind of getting the high level on how that operates.
Yeah, for sure. So when we say derivatives in crypto, most people associate that with finding leverage on things like perpetual swaps or like quarterly futures. And people are probably familiar trading on BitMEX or Binance kind of in the early days, right? The reason that whole industry came about was really like when crypto started initially, it was a fully funded product, right? And what that means is you have to send a wire to Coinbase, right? You have to send US dollars to the exchange before you can actually buy any crypto. And that is hard for institutional market participants to do at scale, because in most other markets, you usually settle your trades after the fact, or you net them off against other things that you're doing in the market. So, from like a capital efficiency perspective, it obviously made sense for derivatives to really like explode as a way to get exposure to crypto, both for retail market participants as well as for institutional participants. And then the other sort of natural trend in the industry over time has just been, there's a sort of trend for extracting yield from productive yield from assets in crypto. And really that just came about because Bitcoin for the longest time really didn't have any productive use, right? It's more of a store of value. You hold it, it has some speculative value because you're hoping it appreciates over time, and other people kind of view it along the same lines as you know, with the store of value thesis. But for the most part, you know, for the history of Bitcoin up to, let's say, you know, 4 or 5 years ago, really when Matt started the lending business here, there wasn't like a productive use case for holding it. So that's when lending really came about. You know, people started deploying Bitcoin and ETH to sort of centralize lending businesses like Genesis to earn some yield. And then over time, that yield obviously compressed, right? And then you saw more demand for borrowing, let's say like dollars and stable coins in crypto. And that was like a new source of yield for people because obviously everyone wants leverage in space, everyone wants capital efficiency. So there was that sort of demand to borrow dollars. And then when that sort of compressed, I think what people started to look for was other ways to use derivatives to extract yield from crypto. And a common trade that comes up a lot is, for instance, you know, buying two things that are correlated. Let's say spot, like you can buy Bitcoin USD on Binance, like the spot asset USDT, and then you can sell the Bitcoin USDT future, right? So those two things in theory should trade in tandem. But usually there's going to be some difference in spread between where those two things are trading. Usually the futures are trading above the spot price. And the reason for that is like I was mentioning earlier, is there's a lot of demand for people to buy assets on leverage. So you can extract some yield by doing those two trades simultaneously without taking market risk. So that's kind of another way of extracting yield out of the crypto market. That started compressing, that sort of basis trade over time. And then you saw a lot of people start to turn to options, and options are a pretty popular way in traditional markets to extract yield by selling volatility, right? So you have a view on some asset, you're willing to, you know, sell your upside on an asset. You could sell calls on something that you own at, you know, with the strike price that matches your price target. So, you know, in the context of something like Tesla, right, you would own Tesla stock, you would sell some call options, let's say, you know, a $1,500 strike call option on Tesla. If it trades above there, then you get called out of the position and you no longer own Tesla stock, but you sort of participate up to that upside, and then you get some yield by selling that call option in the form of premium that you're paid up front. So the same idea obviously applies in crypto. You can do the same thing on Bitcoin. You can do that on ETH. There's, you know, the most liquid exchange out there is called Deribit. They do something like 90-95% of global volume in crypto options. There's a lot of alternatives to that. There's LedgerX, there's OKX has options. There's, you know, even now there's a lot of innovation in the on-chain derivative space. So you can participate in on-chain vaults like Ribbon and Friction and Katana. And these are all sort of new methods for people to sell options. It's all effectively the same type of trade. And that's really, you know, what we do on our desk is we sort of take these more complicated instruments that have, you know, non-linearity in them, and we, you know, we sort of bridge like supply and demand imbalances across all these different venues. And sometimes it's an access problem, right? Some people need to face a counterparty that looks like Genesis because, like Matt was saying, you know, we're set up in the right way. We have, you know, the right kind of regulatory structure. We have a very substantial team of operations and legal and compliance people and traders and risk takers that can sort of absorb risk and price things efficiently for you. And we're kind of using that and packaging that all as a product for institutional guys that want to buy and sell options on crypto. So I've really, at this point, only talked about the supply side of selling options. Those are people looking for yield. On the demand side, you know, it's really coming generally from folks that have directional views that they want to express tactically, right? So you think the merge is on ETH is going to be a big upside catalyst for ETH. You might want to express that by buying call options, right? So on the downside, like you have a day like today, where the market gets smashed really more because of just global macro concerns, but you know, you don't take any pain on the downside. You've already protected yourself by paying premium for a call option where you don't participate on the downside, but you do participate on the upside. So that sort of asymmetry, that sort of nonlinear payout is something that, a lot of hedge funds will use. You can also buy put options, right? It's the opposite direction where you're looking for protection on the downside. That's something like we might trade with, let's say, a venture firm that has a big portfolio of tokens of locked assets, right? So they have exposure to crypto that would normally be hard to trade out of because it's illiquid. And they might use options with our trading desk to protect them from adverse moves in the entire asset class.
Hey Josh, like one of the obvious kind of like high level takeaways that I think myself and listeners will come away from everything you just said was the fact that, the market over time is obviously more institutions are coming in. It's getting a bit more complex, right? And with that, should we be expecting the market to become more efficient? I mean, I think we talked briefly about, Matt mentioned, spreads tightening, the 3-month basis coming down from like 45% annualized at the beginning of 2021. Obviously, like Grayscale was trading at a massive premium, and the GBTC trade was huge. I'm sure you guys played a large role in manufacturing some of those trades. But what do you think about over time? Like, should we be expecting the market to just get more efficient as these entities come in and look to take on these more sophisticated type of trades?
Yeah, I think the efficiency of the market is like this. Sort of like army that's kind of marching across the field, right? And there's like different areas that are closer, right, and more easily accessible to people, and those get sort of arbed out first. And so there's things like the basis trade where all you really need is to have capital, right? You just take dollars, you buy spot, and you sell futures. There's now we've seen just a flood of capital come into the space from institutional market participants that do have the balance sheet to really take advantage of those opportunities. And it's really, there's a risk element of it. Like you have to kind of weigh like the risk of taking exposure to a crypto exchange, for instance, or taking exposure to a counterparty like Genesis that operates in crypto. But as more and more people get more comfortable, obviously the risk premium that comes out of that trade is going to compress. So that is something we see that's becoming much more efficient. Before that, even there was sort of the trade of just pure spot, exchange arbitrage, right? You buy on Coinbase, you sell on Bitstamp. That was like a hugely profitable trade for a lot of systematic trading firms back in 2014 through 2017.
SBF's got that famous story about Japan.
Yeah, exactly. The yen trade or the Korea trade, the kimchi trade.
The kimchi premium.
The kimchi premium, yeah. That's been arbed out already. That's even simpler than the basis trade. We're just taking two like for like markets and sort of collapsing them. And then what we're seeing now over time is the frontier is really on kind of on-chain activities, right? DeFi. You can kind of see like the shift in how people are extracting value from the market is really less about bid offer and more about kind of more sophisticated financial engineering, sort of engineering exit liquidity in some way, or sort of converting sort of time value and liquidity preference into sort of yield, right? So like you have these lockups on tokens, you throw them into single-sided staking, and in exchange you get some yield, but you're locking up your tokens for some long period of time. And there's maybe ancillary benefits to that. There's maybe you get vote. It's like a vote escrow situation where you have some governance rights, but all of it is sort of pricing out and unbundling like different aspects of token governance and putting a price on it. And that's kind of how people are extracting value in the market now, and that's going to become more efficient over time too. But right now, there's a lot of uncertainty of how that stuff is priced.
Yeah, I echo everything Josh said too. And you could also see this playing out in live time. Like we've both been here now, or at least been trading the markets for, 3 to 5 years. And I remember when I first joined in 2017, like spreads on spot, right? Like people would pay 100 bips on an institutional BTC trade. Like we were clipping 1% in on Bitcoin. We were probably clipping 2%, or not in, like 1% notional, 2% on ETH trades. So obviously like spot was the first thing to get, to get kind of grounded in reality and kind of get tied closer to like what you see in traditional markets, even though we still have a long way to go. And then lending rates, right? Those kind of got squashed into what Josh was saying. And then obviously like DeFi now is kind of the next thing. We'll kind of see how long it takes basically for like those with capital to get to a point of sophistication where they're comfortable enough basically arbing that out as well. But then it's like, who knows what the next frontier might be. So I think like, there's going to be pockets of innovation that continue to spur in crypto that then drive inefficiency and arbitrage. And my guess is that like the speed at which those arb opportunities get crushed is going to just happen faster and faster and faster until the market becomes ultra efficient. So when you think about like a trading business, like it doesn't sound great, but at the same time, the pie gets a lot bigger, right? Like as there's more market participants and as there's more, true buy side coming in at some point, right? There's just going to be a bigger pie to kind of go around. And then every big trading firm is going to kind of have their own unique edge and like, really like moat around what they do and kind of core value add. But right now I'd say we're kind of somewhere like in the 5th, 6th inning of like that efficiency curve. We're not quite to the point where you see traditional markets, but obviously we're nowhere near where we started, back in 2016, 2017.
No, that makes a lot of sense. And I was listening to a podcast recently with SBF. I think it was on like Bloomberg's podcast. And he said something that was like really obvious. I just don't know why I never thought about it. He was just saying, well, yeah, like spreads may condense, but at the same time, you can make up by that, by just using more volume. And so he was saying like, arbitrage funds are actually just as profitable as they were back in the day. Their margins just aren't as large because they're just doing more volume to make up for the spreads tightening. So
I think that's exactly right.
Yeah. So kind of going off of this, like, do you guys think these funds that are just coming in, like maybe, salivating at the inefficiencies we still have in this market, although maybe it's, as we just talked about, evolving to where it needs to be. Do you think some of this capital spills over into like just directional liquid token investing? Like, obviously you guys are dealing with these, entities on a day in, day out basis. So do you see any entities that will come in and just be looking to, arb out these spreads? And then they'll say, hey, you know what, I actually think there's actually merit to this asset class, and then become fundamental investors. Like, do you see that kind of water flow effect, or do you think they just stay in their lane of just arbing?
No, I think you can definitely see that effect. So like, take for example, and I've mentioned them a few times, right? Take for example, like Jump or Jane Street, which really entered the market like maybe 3 to 4 years ago, and have obviously ramped up their trading efforts ever since. But now it's like, they're not just trading, right? Now there's Jump Crypto, there's Jump Capital. They're making VC investments like far out the curve in crypto. Jane Street just invested in Near Protocol, right? You have folks like Wintermute and Amber, which also were attracted to the space because of the arb opportunities, that are now like major investment firms that are kind of investing across the infrastructure stack in crypto. So I think like, you are starting to see that. And even like 3 Hours is a good example. Like they came in probably to, trade basis, and they really ramped that up. And then obviously they invested in Deribit, and they're one of the larger VC presences in the space. Even look at like the Alameda story, right? They came in to basically arb the Japan USD trade, and then they wound up creating one of the largest exchanges in crypto, and are obviously running a $2 billion venture fund, have created tokens. And then even on the banking side, take for example, like Silvergate. They came in obviously because they thought spreads would be attractive to be a lender, to bank, crypto trading firms, and kind of clip spread there. And now they're buying like the intellectual property from, Facebook for the payments network DM. So I think, you're starting to see like all these firms that kind of came in to kind of look for like low hanging fruit ways of monetizing, their businesses. And, at some point, I think a lot of them we're almost fell in love with the concept of what crypto can be, and obviously wanted to kind of level up their participation and actually, take a bite of equity and put some skin in the game and invest in various things across the space. So it's been, I think, the evidence is there for that, for sure.
That's really insightful. That's kind of like what I had guessed, but it's really interesting to hear that firsthand from you. I want to get to your guys' thoughts on the current state of the market. But first, before I forget, Josh, can you talk to us about this news today? I've been seeing this everywhere on Twitter. Luna Foundation Guard acquiring another $1.5 billion of BTC. You kind of facilitated this. So could you kind of walk us through the details of kind of how this went down and what this means?
Yeah, absolutely. It's an exciting transaction for us to be involved in as a firm. It's not every day that we get, someone calling us on the desk and say, I want to buy $1 billion of anything really. So, it is a testament actually to the asset class too, that we're at the size where we start talking about billions with a B. I think we couldn't have really found a better partner in this than kind of the guys at Terra and LFG. We had a good opportunity to kind of talk to a lot of the folks over there across various conferences, and conferences was just a great way to meet them because they are kind of scattered around the world, and a lot of them are obviously in Korea. But they've built out this enormous ecosystem. There's huge amount of appetite, I think, from both retail investors and institutional investors to get involved in what is effectively now one of the largest L1s that can support, real robust DeFi activities, payments activities. The money markets that have been built in Terra are, supporting $20 billion of assets and in more really over time. People have very different views, obviously, on the asset class and kind of like, the direction of it over time. And I think we're sitting there in the middle. We have a lot of counterparties that are active buyers and sellers of these assets, Luna, UST, and now kind of Bitcoin, which has become an integral part of the Terra ecosystem as a way of stabilizing their UST stablecoin. So we're really excited about it. I think it just provides, we're a good kind of on-ramp for a lot of institutional guys to get access to that space. So we're actively trading it, we're actively lending it and borrowing it from counterparties so they can sort of generate yield through our trading desk. And I think, it's sort of a major one for us these days, but we're seeing a lot more ecosystems come up, alongside Terra. It's going to be, definitely a multi-chain world. And for the folks that have a hard time sort of accessing directly on chain, we're a good way to sort of get access and get the sort of yields that you see in DeFi, but maybe have a hard time accessing.
No, thanks for expanding on that, and congrats on facilitating it, man. That's huge. Everybody's been talking about it, so it's a huge transaction. I want to kind of ask you guys about like what you think about the current state of the market. I mean, we've seen this aggressive sell-off now for several months in equities, BTC, and fixed income. Obviously macro's kind of been in the driver's seat. We reached like a record high correlation to the Nasdaq. In the Nasdaq, I think in the last 2 weeks or the last 3 weeks, but it's been like tremendously high, regardless for the last month or two. So what do you guys kind of think about the state of the broader markets, as well as kind of how that's been tying into BTC? Matt, I guess we can start with you.
Yeah, for sure. I mean, so I think like when I think about my view on really Bitcoin or the crypto market generally, like it's usually like from a multitude of different lenses. It's like easy to get caught up in like the day-to-day price action, like especially on a day like today, when everyone like all the sentiment now is like super bearish, and you're seeing like risk being taken off, not only in crypto, but obviously in equities as well. But like, that's where I think as a prudent investor or someone like looking at the space, like you have to kind of have multiple lenses at which you kind of assess these things. So, I think the main, lens number one for me is like what, like over the last 5 years, what I love about the seed is like we're a nexus for basically everything happening in the market, right? We see all the information flow, we see the investment, we see the capital flow, we see the emergence of new infrastructure. And so to me, like that, the growth, right, is so obvious. It's been a one-way train, like it's been burning since the day, I stepped in the door, where like that to me is like the long-term trend line of the asset class. And it's like only going in one direction, and it's definitely exponential in nature. And that, like, when you think about just like markets generally or like economies generally, that's like that element of like the constantly burning evolution that is like taking productivity higher. And to me, that's like clearly on a fast track, right? So that is like super bullish. Then the next lens is like, can you sense check that with like, is this market or is this asset class like relevant kind of in the world we live in today? Obviously, I think this is a no-brainer, right? You see what's happening, in Russia and Ukraine in terms of just like, obviously we're at war. There are sanctions all over the world. There's almost this like emergence of like deglobalization, where like countries are kind of more siloed. So like having an asset that is borderless, that's internet native, just makes a ton of sense, kind of given the backdrop, both overseas and in the US. And then you kind of compound and layer on the fact that like we've just experienced 40-year high inflation, right? And you can have something that is literally immutable, that's programmed to be deflationary. That's also kind of internet native. Just makes a ton of sense when the world is literally moving, more and more digital by the day. So like from a sense check narrative perspective, it supports the productivity of the asset. Then it's like, okay, well, like why are we selling off then? Obviously, and obviously, people can point to, we've had a historic run back in March of 2020. Right as COVID hit. The expectation was that, right, there's going to be a ton of stimulus in the economy. Borrow rates are going to go to zero. There's going to be a lot of loose credit. And with that, inflation was probably priced in to be pretty high over the next few years. And what's a great asset to basically ride the coattails of that? That's Bitcoin. Now, obviously, we're going the other way. And it's, we've seen some of the record-breaking inflation prints where, the Fed has to actually do something about this now. And you're starting to see credit markets immediately react to that. If you just look at the 10-year or really any point on the curve, rates are obviously skyrocketing now, which means equity valuations across the board are going to get destroyed. And so there's going to be a massive risk off in equity markets. And unfortunately, crypto, despite it having other properties, is pretty far, on the far end of the risk curve, and has been, to your point, super correlated and will likely stay super correlated, to equity markets, which everybody knows are going to kind of continue to sell off. How much of that is priced in at this point is anyone's guess. Probably, at least half, but there's probably more room, I think for equities to go lower and then probably crypto with it. But then it's like, okay, until what point? Like, what's the thing that's going to kind of be able to catch the bid? And I think the asset class has to kind of decorrelate from equities. And the only way that's really going to happen, in my opinion, is like this chugging along adoption curve, where folks that aren't participating in the market today kind of really start to understand and immerse themselves in the asset class and ultimately decide to take a position, because I think it makes sense from a valuation perspective, and also just from what's happening in the world. Does this asset fit the bill? And I don't know quite what level that's going to be at. I mean, my guess is we trade lower. I think the low 30s, I could see us going to the high 20s, but ultimately I think there's going to be enough adoption and interest from both new participants and then also those that are like long-term holders in the space, that are going to be willing to buy at those levels from those that have softer, weaker hands that kind of, sell to them. So until you see that transition from active traders, speculators, shorter term holders that basically redistribute that supply into longer term holders that are willing to just buy and kind of take more and more of that share, that's ultimately then going to kind of get us there, I think, in terms of catching the bid to the upside. But it's obviously going to be a pretty choppy year. You could also look at things just some of the data points in terms of we talked about funding spreads earlier. There's clearly not that much leverage right now in crypto if you just look at kind of basis or perp funding rates. So I think we're less susceptible to some of those big wicks down that we've seen in previous drawdowns when funding was to your point 40 or 35%, right? Because it's not like you see a bunch of people speculating on the levered long side. So I think it's going to be more of a grind down like we've seen in the last 3 months. It's going to kind of level out at some level, and then hopefully, right, until we kind of hit that next part of the adoption cycle, and then it's rinse and repeat. Then you're going to have the speculators lever up on that kind of new part of the cycle, and we might reach all-time highs at some point. But so to synthesize that, I'd say it's short term pretty cautious, relatively bearish, medium term, neutral to bullish, and then long term, obviously, super bullish.
Yeah, I think Matt laid out a pretty good longer term kind of perspective. I'd say from my point of view, just in a short term basis, if you look year to date, right, Bitcoin and ETH, let's say, are down something like 20%, 24% respectively. And then you have other risk parameters like NASDAQ down, let's say 20, 21, 22%. And, on the kind of far end of the risk spectrum, you have something like RK, the sort of ETF that has a bunch of the sort of growthy tech names down something like 50%, right? So, that's surprising to a lot of people, right? Crypto has really outperformed what you would consider to be safer basket of risk assets, equities. And I think the reason for that is basically twofold, right? One is Bitcoin has seen a resurgence of this narrative around it being a non-sovereign store of value. And when you have a world where Russia's invading Ukraine and you have, central bank sanctions being imposed, there's sort of a desire to rotate into assets that are not attached to a specific government and are maybe a little bit more censorship resistant. And that thesis has always been around for Bitcoin for many years, but we're seeing it kind of play a much more central role in a lot of people's mindset and kind of thesis development. So that's one thing. And then the other thing is just around ETH, right? ETH has its own set of catalysts this year, primarily centered around the merge, which is it's been pushed back, but people kind of thinking like later half of this year. It's a huge, fundamental upgrade in the way the protocol works. It's going to become a proof of stake consensus mechanism, and that's been driving a lot of inflows into ETH as well. Not just the merge, but also you have a lot of the layer 2 tokens launching as well. You already had Optimism going to make an announcement, and it's bringing a lot of enthusiasm back for ETH as this distributed computation layer for people. So those two things put together have really put a floor on crypto prices. And I think what people have kind of forgotten is that, in a situation where macro breaks down to the extent that it has so far this year, and it's largely driven by sort of concerns around monetary tightening and things like that, everything goes to one. Like all the correlations go to one. And even if you think you have sort of a differentiated thesis for crypto, you kind of need to wait it out. You need to wait for a point where, people's sort of thesis on crypto can actually be expressed and can play out in a way that is outside of these sort of forced liquidation moments. So I think what we're looking for is a period of stability where a lot of things are priced into the market correctly. Right now, I think especially today in equities, NASDAQ down 5-6%. I think what you're seeing is a lot of forced selling, a lot of liquidation in hedge fund portfolios. People are sensing blood in the water for a lot of different large firms out there that are holding positions, concentrated positions in tech and Chinese ADRs, all kinds of things. And that's really what's driving what's happening today. You need to kind of get past a lot of that noise in the market before you can sort of really express a view on crypto that it'll outperform.
Sure. No, that's super insightful. And like one of the things that Matt said, I want to get your opinion on, Josh, was the fact that he sees a lower likelihood that we have like this final capitulation wick down, and we probably see a slow grind down, bottom out, and maybe the upper 20s, maybe mid 20s. What do you think about kind of the derivatives positioning compared to, let's say, like a March 2020, right? Where you have like funding pretty jacked up, sentiment pretty high heading into the halving in 2020. Also you had BitMEX was still, a really, dominant driver of volume in the space, and their liquidation engine was a little more aggressive. And then one of the other things that I've noticed is like the percentage of the futures open interest collateralized with crypto versus cash, and how we've kind of seen that transition over to, from down like, I think it was like 70% margin with crypto to now like 40%. Do you think some of these things, and maybe anecdotally, obviously can't talk about like individual clients positioning, but anecdotally, do you think we're seeing a much more defensive setup, and that would kind of lead you to believe like kind of what Matt is saying, that the likelihood of some type of final capitulation wick down like a March 2020 is lower in that sense?
Yeah, I mean, I do think there's a lot of leverage that has already gotten taken out of the system, and it's primarily because we're in the range that we've been in for a long time here. We're plumbing the lower ends of that range, but it's already been covered. Like there's already been a lot of liquidation, and the market hasn't exactly been conducive to retail taking a lot of long punts. So everyone is sort of exhausted, right, with equity markets being the way they are. There's not a ton of speculative capital on leverage anymore. I think Matt is sort of right in the sense that I think the next phase of this market is going to be more long sellers that are capitulating, and that tends to be much more orderly. And in particular, I think there are a lot of holders out there that are highly visible, right? There's a lot of corporate treasuries out there that have published, their average cost basis. There's a lot of DAO treasuries and things like that, just large holdings, and also a lot of public companies now have visibility into where on their balance sheet they have crypto exposure, whether it's like Coinbase or firms that are holding some of the ETF or trust products out there. So that's going to be the next pressure point, right? You could even mention things like sovereigns, right? Like El Salvador, which has obviously seen a lot of pressure in their sovereign credit spreads recently. You can think that if there is a highly visible liquidation from somebody in the market, that would really put pressure on crypto, and especially as we get to some of those trigger levels where there's either going to be constituents that are pushing for a liquidation and a reduction of risk. And people are still sitting on gains for the most part, right? So people are going to want to act to sort of protect those gains, especially if macro conditions get worse. So I think that's the next phase. I think that'll be a little bit more orderly than sort of these massive liquidation wicks. And the other thing about BitMEX in 2020, fast forward to now, there's just a lot more venues out there that have if not safer liquidation mechanisms, at least more diverse types of liquidation mechanisms, right? And the diversity means that there's less concentration of risk in any one candle getting liquidated. So I kind of feel like that provides a little bit more stability in the market. And look, honestly, like you look at it now, like if there was a lot more concern about this sort of volatility, you would see that expressed in implied vols and options. Even today, we saw just a ton of supply in options on the desk, people selling it. And that's been a theme all year long, people selling options for yield. There's much less concern about covering the tails as there is just sort of thinking that we'll trade in this range or maybe just grind lower over time.
Yeah, no, that's super insightful. Guys, I could talk to you for like 2 or 3 hours. I got a bunch more questions I could ask. But I do want to be respectful of your time, and I want to kind of wrap it up here. First of all, I just want to say thank you to both of you. This was super insightful. I mean, very rarely do I actually go back and listen to the podcasts, but this is going to be one where I'm going to probably listen back 2 or 3 times. So, I want to say thank you for coming on. And do you guys have any kind of last words or anything you want to plug in before we wrap up? Matt, I guess we'll start with you.
Yeah, no, thanks so much for having us on. It was really, really great to talk to you, and I'm sure we'll do it again sometime, maybe in person over a beer. But no, last words would just be stay the course, believe in the thing you're investing in, and everything is cyclical. Everything is cyclical in both crypto, which is really just kind of like a small part of kind of global markets, but tends to kind of work in a similar fashion. So just be disciplined. And kind of trust in the cycles.
Yeah, and if I can add to that, like all the best stuff in crypto has been built in bear markets. I hesitate to use that word. I don't think we're really quite there yet, but yeah, like all the good things come out. Like all if you look at venture portfolios, all their best bets are really made in these sort of like rangy or bear market type periods. So there's going to be a lot of good things coming out in the next few years, and we're really excited to be a part of it.
Guys, we'll have to have you on maybe in a quarter or two, but this was amazing, and thanks again. We'll talk soon.
Thanks, Phil.
Sounds good. Thanks, Phil.